Case study, solar power plant. Imagine a solar power plant with a planned capacity of 100 MW, requiring $200 million in financing. The project has a 25-year power purchase agreement, PPA, with a utility company and is expected to generate $20 million in annual revenue. The plant has an expected construction period of 2 years and an operational life of 25 years. Financial modeling. A financial model is developed to project the solar power plant's cash flows, incorporating factors such as capital expenditures, CAPEX, the cost of constructing the solar power plant, including equipment, labor, and permitting, operating expenses, OPEX, ongoing costs such as maintenance, personnel, and insurance, depreciation, the reduction in value of the solar power plant's assets over time, tax considerations, the impact of tax incentives or liabilities on project cash flows, sensitivity and scenario analysis. Sensitivity and scenario analyses are performed to identify risks and determine the project's viability under different conditions. Key variables analyzed include solar radiation levels. The amount of sunlight received by the solar panels directly impacts energy production and revenue. PPA price fluctuations. Changes in electricity prices in the PPA can affect project revenue. Construction costs. Unexpected increases in equipment or labor costs can impact project profitability. Financing costs. Fluctuations in interest rates may affect the cost of debt. Debt structuring and sizing. Based on the financial model, an optimal debt structure and size are determined to balance the cost of capital with risk management. For this project, the financing might be structured as follows: $120 million in senior debt, 60% of the total project cost, with a 10-year tenor and semi-annual repayments. $40 million in mezzanine debt, 20% of the total project cost, with a 12-year tenor and bullet repayment at maturity. $40 million in equity investment, 20% of the total project cost, provided by the project sponsor. Financial risk management. Financial risk management techniques are implemented to hedge against interest rate fluctuations and currency risk. Interest rate swaps. To hedge against interest rate risk, the project sponsor may enter into an interest rate swap, exchanging floating rate interest payments for fixed rate payments. Currency forwards. If the project has revenues or costs in different currencies, currency forwards can be used to lock in exchange rates and minimize currency risk exposure. Conclusion. By applying financial engineering techniques, the solar power plant project is structured to optimize financing arrangements, mitigate risks, and enhance its financial viability. This well-structured project financing ensures the solar power plant can be built and operated, contributing to a cleaner energy future. That wraps up our discussion on project financing through financial engineering.